Thursday, 18th of January. With me today, I have friend of the show, the mighty asset capitalist, Hugh Hendry. Hugh is in London, and we've taken this opportunity to chat through his thoughts for 2024. Hugh, welcome.
Nick, wow. I'm full of trepidation. I don't know if my mind has survived my partying over the New Year period, but we shall see.
So you're in London for a long time, or just a couple of days? What's the plan?
I mean, it feels existential. I am in London, but I come carrying the festive kind of flu, if you will, and so I'm kind of coughing my lungs. But I'm in London. I'm going to celebrate the 20th birthday anniversary of my oldest daughter.
Oh yeah.
So I'm going to have another party tomorrow night, and then I'm back. Whilst it's beautiful sunshine today, it's bitterly cold. So I'm going.
It is
back
bitterly
for some
cold.
hot sun.
Let's talk about your thoughts for 2024. Let's go on a macro asset capitalist trip. I think there is a question that most of the market is wanting to know the answer to, and most listeners, is when do you think the Fed will cut rates?
Heavens, the Fed. I come from not a land down under, now singing songs from the 1980s, but I come from a little faction that hotly contests the origination and the direction and the influence of interest rates. And I think it's most closely associated with a Swedish economist from 100 years ago, Kurt something, or a Weasel, I don't know, pop goes the Weasel. But he had this kind of natural rate of interest rates to say that it's determined by the circumstances, that it's all a facade, these policymakers, and that these, the great complaint about the last 10, 15 years that somehow rates were so low and they were kept unnaturally low by the menace of policymakers. I find that absolute nonsense. Rates were determined by supply and demand. Mm-hmm. Banks were overwhelmed by deposits because the private sector had no appetite for entrepreneurial risk. And so the interesting aspect, it's all interesting, but the course of the last 18 months for me, watching from my little legion, is that we had this distortion. We had policymakers actually confront rates and actually impose their view of where rates should be, had to be. And my view has always been that as almighty as these great offices of the Federal Reserve and the Bank of England and the European Central Bank seem to be, they're kind of puny versus the overwhelming forces. And the forces perhaps I'm alluding to, people say, well, why are you still referencing the great financial crisis of 2008? And I'm referencing it still because I feel that that's the prevailing monetary climate, and that the issues that came to the fore have never actually been successfully challenged or given the chance to heal. And therefore, I still see that the natural rate of interest rates is actually very, very low.
Mm-hmm. Okay. So does that mean we see the Fed then cut rates quite aggressively, or do you think it's still too early for the Fed to make that decision in their policy?
I guess I want to quote the legacy of observations. The Federal Reserve cuts rates very rapidly.
Yeah,
that's what they do. And why is that? Because again, they're fighting a natural course that's bigger than their intellect. So I wrote back in November. So here I am. I'm suffering from a flu. Back in November, I was suffering from dengue, from the mosquito. Gruesome thing. I've had it 3 times now, and it's a real bone crusher. But back then, on medication, I wrote a paper called the net positive coefficient. I think, something like that anyway, where I drew comparison with the travails and, of course, the disaster of the Chernobyl nuclear power plant and subsequent explosion. And I likened that to this universe of monetary central banking and the monetary universe. And if you will, a nuclear reactor, you've got this, think of it as a melting pot full of these nuclear fusions, and that's creating the energy. And that's very analogous to this the enormity of the United States economy, and thousands, if not millions, of transactions. It's the energy of the economy, and you have the Federal Reserve, and you have the guys working at the control panel in Chernobyl, and they have, if you will, if we think of it as a bowl of soup, there are kind of knobs for controlling the temperature. It's a little bit Goldilocks. We don't want it too hot. We don't want it too cold. And the great malaise of Chernobyl was severalfold, but it came under this notion of a positive void coefficient, whereby the actions of the administrators and the controllers to rectify and to bring it back to the mean, if you will, actually did the reverse. They accentuated and they created the explosion. And some of the things were unique to Chernobyl in that you would insert control rods when you wish to kind of bring it down.
So cooling rods.
Cooling rods, exactly. And who knew, certainly not the control guys, but they were too short.
Yeah.
They were too short for that particular reactor. And secondly, the coolant that was being used was graphite. But graphite shouldn't really be used in a water-based system because it's like pressing the brakes. You actually accelerate initially. And I feel there are elements of a void coefficiency in the journey that the Federal Reserve has taken. And that comparison, and also that comparison that you are invested as the controller with this certainty that you press this button and there are definite actions. And complexity takes forward. And I've always maintained the absurdity, the precision with which we talk about GDP. We measure GDP quarterly. In the UK, we're measuring it monthly, and we're measuring it to 2 standard deviations. It's preposterous, right? And what you actually, again, if we go to the legacy of observations, what you discover is that the Federal Reserve, think of them at the control panel of this nuclear power station, when they're most called upon to use their skill set, they're typically dealing with bad GDP data, which is to say, 1 year, 2 years, 3 years later, the data is revised conclusively.
Exactly right.
Away from what they thought. So that's going on. But in terms of the void coefficient and trying to parallels with these control rods and the coolant, the great shock was the period 2020 and 2021 with the great fears concerning civilization, but concerning where the economy might go, was that, of course, long-term rates dropped profoundly below 50 basis points on the 10-year, below 2 percentage points on the 30-year in America. And that allowed for the private sector to refinance. And it wasn't like they had a window of opportunity. You had to do it or you missed it. Yeah. They had like a year to nail this thing. And they did. And so up to 30-year maturities, the private sector immunized itself. And that kind of feels a little bit like you're the Fed and you're putting your control rods. You're raising interest rates, but these control rods going into the reactor, they're too short because everyone's actually immunized. They're like, well, that doesn't affect me.
Yeah, exactly.
I don't care. I'm fixed for 30 years at 2.5%, Mr. Central Bank. So that was going on. And of course, it seemed to require more pressing of the buttons, if you will. And so again, if I cite observation, we had the magnitude of the rise, essentially from 0 to 5.5. Yeah. And the period in which we got there was the most rapid and most intense.
I mean, it's breakneck velocity.
Hiking. And so that concerned me at the time because we live in an era of unprecedented leverage vis-a-vis the size of the economy.
Yes.
We're like 3.5 times debt to GDP. Now, we're there because asset values are also at unprecedented high levels versus the income that we define as GDP. But the fear that we have is sometimes we have this, it's called the bezo. The bezo is the mark on assets. And they're not marked in, it's not this stationary thing. They change, they fluctuate. And if the asset value changes, then you get this duress where your ability to service that debt gets called into question. So here we are, and all of that has happened. And this nuclear power plant, the inspectors are going, I mean, I don't know. I've raised interest rates a lot. I've done it very rapidly. If we look at the third quarter GDP for America, it grew at 5.5%.
Yeah.
And the unemployment statistics, which I think are subject to a long debate, but first-hand reflection,
Still quite hot.
super hot. So the reactor's super hot. And then we got this strange event in December where the Federal Reserve went, holy moly, something's not right in the reactor, and we've got to tell you, next year we're going to be cutting rates. And everyone's like, oh, really, really, wow. So we're live. They're going to cut rates.
Yeah.
But I find the better question is why. I think you're going to ask me why.
Well, I will ask you why.
Yeah.
Let's go into why, because maybe we'll come on to inflation, but why?
I have no idea. Why? I mean, why is guesswork? But again, it's back to the natural flow and tendency of the monetary order. I'm making this reference point to 2008, and what we can say is that the Federal Reserve now is actually coming closer to the view of the fixed income market, which for over 2 years
there's been a disparity, hasn't there?
Disparity between the short end and the long end. That the fixed income market has been saying these rates, the fixed income and the curves, the inversion in the curve market, the market has been saying these rates are not natural.
Yeah,
the natural tendency is for things to be much lower. But the Fed's had the supporting brief of the labour market, and the GDP's held up.
Am I right in the 70s we saw inflation, rampant inflation, quite aggressive inflation like we've seen here, then it tamed, and then it went again. There was a second wave of very high inflation.
Yeah.
If the Fed begins to cut rates now, and we have other issues going on around the world, geopolitical issues, is there not a risk that actually inflation comes back and then we're in a position where rates have to be raised again? If 2% inflation is a government target?
Well, this is the narrative of the most boring market commentators. They get all the column inches in the platforms and the daily financial news. Why do I think it's absolute nonsense?
Yeah.
Why? Again, it's back to natural tendencies of flow. And in the 1970s, there was a profound a newly powerful force behind the infusion of money or the creation of money. Latterly, I mean, back then we never discussed this, but today we've got terms for it. We call it the euro dollar market, and that can relate to many things. But when I say that is the creation of dollars outside the sovereignty of the United States, outside its borders. This is overseas banks creating dollar liabilities. And that began to become really a big market moving thing in the 1970s because, of course, we went from $2 to over $20 in the price of oil. And those Arab nations are not populous. And so it created an immense surplus of national savings, which went on deposit.
Yeah.
And then on deposits, a liability for a bank. The bank looks to create an asset as a loan. And so we had an enormous tear in predominantly South American sovereign lending to places like Brazil and Mexico in the 1970s. But elsewhere, banks were falling over themselves to make you a loan, to create money. And that is the plasticity which supports higher and higher prices.
Yeah.
because your wallet,
Yeah.
if you will, there's more and more dollars going into your
Yeah.
wallet year over year over year, and so you can sustain prices. Now the zenith of that was 2007, where again, we had this thing, liar loans or whatever, ninja loans,
Yes.
no income, no job,
Yeah.
etc. Where you're almost, you would have this long epitaph about how you just got divorced, you're out of prison, you got a drug habit, and then the bank's like I'm busy, do you want the money or not? They were desperate to give you the money. That generosity or idiocy or whatever came to an end back then. And there are many overarching reasons. I say the overarching reason for that, it's too much to go into right now, but is the rise of the free capital flows and mercantilism and how we've engaged with world trade in the last 3 decades. Yeah. But that since 2009, money has not been plentiful. And so there's not the pumping up of your wallet with dollars that can support more and more and more spending. And so what we have seen is that discretionary spending has actually had to be reined in.
Yes.
And you're now seeing very sharp deceleration in prices. It looks very much like the period after the Second World War.
Okay.
The enormous price surge in the immediacy where there was supply disruptions.
Yes.
We had to reconfigure.
Which we had with COVID.
Which COVID was a war.
Yeah.
COVID was a global war. Yeah. And there was immense reconfiguration of supply. And then there was an immense, who knows if it was wise or not, but the stimulus checks, I want to say it was wise. They had to do things back then. But it created an intermediate and a very powerful thrust of higher prices. But I, for one, was using the background noise of the monetary condition to say that it would not be long lasting.
Okay. And let's change tack a bit. Who do you think is going to be the US president come November?
It would seem there's an inevitability about Trump, but again we just have to still be we have to make sure we don't swallow newspapers. There's data. So, for instance, Trump obviously did very well in the caucus.
Caucus, the Iowa, yeah.
And so you see these unprecedented that he got over 50% and nearest rival was maybe 90. Yeah. 7% of all Republicans who are registered in the state of Iowa, which is not a big state, voted.
Yeah. I mean, that's not
still very small
voting.
data sets. And the Republican assault on the ladies, with the abortion thing is, and we saw it in the midterm elections where you didn't get the Democrats being kind of driven out, if you will. The force was less intense. That still is out there and it still ruminates. And so at this point, I want to say we don't know. There are many shocking things or otherwise that could still happen. We are talking about Biden and Trump, who are elderly and who are subject to stressful lives. And so let's see. But removed from markets, as an individual trying to make my best on this planet, I kind of, you don't fear for the people that Trump surrounds himself in terms of the economy. A lot of the decisions seem to be on the right side, but the morality and the test to American democracy is something that, just personally, I hope we don't see a rerun of.
No, I don't disagree with that in any way. It's interesting to see that the dollar rallied aggressively on the Iowa caucus's results. Actually,
you think so? I actually, for my sins, was staring at the dollar chart today, maybe in preparation for this conversation, and if you can make that chart say anything, then kudos to you. It actually comes back to what we were talking about, this natural tendency of money and the next step in interest rates. That actually, there are, can I say, intermediate trends? I mean, there has been an intermediate sell-off in the dollar ever since really the mini banking crisis of the end of Q1 last year. And I want to say the dollar tumbled from 116, like the Dixie, the dollar general, to 100, let's say.
Yeah.
And we're now at like maybe 103, 104. Those intermediate moments, they tell you that when they tell you that the banking sector gets a little bit of not acid reflux, but the opposite. Over that period, people just got a little bit more bullish on the world and more willing to accept in this world of Eurodollar. The dollar movements of that nature tend to suggest willingness and confidence in asset collateral, because it's all collateral-based extension of credit today. And they were more willing to extend that kind of credit, and markets took a bump to the upside. And if you were to get into the prognostications of 2024 and where will we be, you could kind of read it through the lens of the dollar. If the dollar, like I said, is 103, 104, if you tell me it's 90 at the end of this year, I'll tell you that risk assets have had another incredible year, because my submission would be that asset-based collateral lending would be robust, more than robust. If we're more like 116 heading to 120, it's like, oh boy, I would say Federal Reserve rates will be close to zero, and there will be a fire sale of asset prices. So at least we've got something we can watch. My if you had to press me, which would be fair enough, I still feel like it's a higher dollar, and therefore look out. I actually think whoever becomes president this year might be eclipsed by the circumstances.
Yeah.
Can you say that Obama was? I mean, you can't say he was eclipsed, but he was the first black president. But he came to office in the depths of what an ongoing depression, actually. So I still think I'm fearful of the portents for this year, the portents of what the Federal Reserve can see, and kind of glimpses that I get occasionally when I look at my computer.
And then let's go a little bit farther afield. There's been a lot of commentary about Japan this year, not just the equity market, but just in general. And actually, maybe the idea of a rate rise in Japan leading to a stronger yen. Any thoughts there, Hugh?
Categorically, there will be no rate rise in Japan. I mean, that it had some impetus behind it in the second half of last year, but the inflation, the retreat of inflation, it may well prove somewhat erratic, but it is almost certainly in retreat, and that is globally. And I mean, sometimes I get bored and I kind of look at Japanese government deficits and spending and size to GDP. It is, holy moly. These guys really, that system works with it. Interest rates, they're not low, they're still negative in Japan, and for good reason. So we've got to within 7% of the all-time high in the Nikkei, 40,000. And Japan is something which has, I can't say it bookended my career, but my first year as a graduate in an investment management house, because I had a relevant degree. I'd studied accountancy and economics and whatever, and we'll put you into Mad Japan. And so I covered Japan for 1 year from October 1990 to October 1991, and of course it just come off the high. I think we come down very rapidly from 40,000 into like 28,000, and of course the partners were, it's going back up. It's like, oh, give us more money. And like, guys, it's over. And also during my hedge fund career, I was the guy. When would that have been? Pretty sure it was 2007, maybe 2008. I was buying 40,000 Nikkei one touches with a 15-year duration. Could it be? So if it was 15-year duration, it was a 10-year duration, 10-year duration. So I got taken out in 2018. But there were times where that one, because the guy's like, wise man from London, what? Can you repeat? Do you want to buy one touch on 40,000? I'm like, yeah, hit me. I was changing one of the kids' nappies, I think, back then. And it's something you spend, the hedge fund is hundreds of millions of dollars and you spend $50,000 or $100,000. But when it hits your mark, when you wake up, you go into the office, it's marked at zero. Yeah. Rightly, I guess. But yeah, if I'd gone for a 20-year 40,000 one touch, I'm pretty sure I'd get touched, and that would have been interesting. But the positive void coefficient comes to mind. The fact that with these control rods not being the thrust of the control rod, the coolant kind of creating an accelerant, and so these 5.5% interest rates on the dollar global standard. Perhaps the most visible repercussions of where Fed policy went post-COVID may be felt in the Orient. And I see Japan and China co-joined. And it's a hard one for me because without a doubt, you're at the point of kind of you're going to break out on the Nikkei and Warren Buffett has bought trading companies and the like. And people want to tell you good things about the banks. I actually think trying to rationalize what happened in December with the Federal Reserve, we're like, we're fighting inflation, and we're hard money people, and then we're going to get rents. Yeah. I was like, what happened? And what do they see? What do they see? So let me tell you something that I have seen, because this is all very much, it's almost like fantasy soccer, but what I have seen is not a fantasy, has been an extraordinary 2-year period of weakness in the dollar yen. Yeah. Yen has always been a notoriously strong currency for many valid reasons for that with regard to the Japanese trade account. And it would trade roughly 110. Mm-hmm. But we've been as high as the high 150s. Yeah. And that was written off as, well, they're still sitting there with negative interest rates at the very short end of the tenor, and the Federal Reserve is at 5.5. So this is the natural repercussion of that. And of course, in the aftermath of the Fed's wobble, what have you, we had quite a stinging return to strength of the yen. We went into low 140s, but I look at that chart, and again, when I look at charts, I reminisce about a legendary hedge fund manager, Bruce Covenor. His legacy firm is Caxton, who are enormous in London. Great company. Really, Andrew Law's chief executive, British guy, making a really fine hand. But Bruce was one of these guys. He looked at markets, and he said, he's like, I'm listening. What are you telling me? And I've always been drawn to that kind of approach. There's a great deal of hubris in markets where we pontificate and we tell markets where they're going. Exactly. I've never been like that. And some of the greats are like, no, the market's telling me extraordinary things. And such was that impulse from 110 to high 150s in dollar yen, that when you look at chart 30, 40, 50-year charts, it's kind of saying the ground's breaking here. I can't tell you what it is, but for this to happen, this is so unprecedented that we should go looking for reasons that would explain why this will continue. Yeah. And that's what I've been doing. And where that journey takes me is, so we've mentioned collateral-based lending. Collateral-based lending typically goes into financial speculation. So hedge funds never buy stocks or bonds with cash. They just pledge their existing assets, and they get almost infinite leverage with that. We mentioned the euro dollar, which makes it sound as if it's London and Paris and Frankfurt. Biggest euro dollar market is Tokyo. Yeah. Japanese money center banks are enormous. And Japanese, as we know, Japan has been in slumber for 3 decades, but you're still charged as a credit officer with taking a risk.
Yep.
And so Japanese banks have looked at their biggest corporate clients. Where are they? They're in Japan. So, of course, they're based in Japan, but they're investing in China. And Japan's one of these places, a little bit of group set. So they've got form. So we had the Asian tiger crisis of 1997.
Yep.
And what did you find? You found that Japanese banks were at the epicenter of, they had overlent. Their exposure into places like Indonesia was way beyond the pale versus their international comparison banks. And so people like Barclays in the interbank market were lending to these huge monolithic Japanese banks and making a lot of money because the spreads, the chart, you could charge them more and more as the perception of risk. And then the risk officers in London and elsewhere said, we can't lend these guys. There's too much risk in their book. And so my fear is that Japan got caught up in the China enigma, which the Chinese Communist Party created. We are linear GDP. What GDP growth do you want this year? 5.5?
You've got it.
Well, going to go to 5.5. Boom. Wow, this is amazing. And so as an interpretation of dollar yen, I imagine, and actually we must bring in. Any macro conversation still has to have quantitative easing or quantitative. We're in an environment just now of tightening, but the environment has been easing. And again, I've always there's no easing in quantitative easing because it misses the psychology of risk-seeking banking agents. But taking this analogy and experiment, thought experiment further. What if the Japanese had actually taken the assets, the bank reserve assets, which quantitative easing creates? So quantitative easing creates an enormous surplus of reserve assets. But the banks do nothing with the reserve assets. And so the what if question is, if the Japanese banks had taken those reserve, basically JGB cash securities, and they went into the Eurodollar system, the international market, and they used it as collateral with the global pool of savings, and from that they effectively would have a short dollar position, and they took term and credit risk by following their customers into China. What resonates with that is that the initial spark where the yen began to weaken was not Fed policy, but was actually the world coming to terms with the bubble in Chinese property and the Evergrande when that started to raise the attention of others. That's, you can kind of date the move away from 110 to there. So, and each day that continues, your counterpart, because every day in the Eurodollar system, you have to come back to the bank and say, are we okay? And it's like, yeah, we're okay. But actually, given the movements, the bank's been saying, you know what, I'm really kind of not great. I kind of would like to reduce my exposure. And when you're reducing your exposure, you're actually buying dollar assets.
Yes.
Yeah. And so you put thrust behind the currency. So there's that. There is Hong Kong and China. I mean, Hong Kong really is just, it's really China. China was not, China, as we know it, this linear GDP was conceived of in the aftermath of 2008 when interest rates were, the dollar reserve was at zero. I am not sure that China et al. Works at 5.5%. And last night or yesterday, I'm not sure if Hong Kong, the stock market was closed overnight, but the last print, Hong Kong was down 3%. The Hang Seng is, wow, I mean, it's really, really heavy.
Yeah.
You've had big risk asset recoveries in the rest of the world. You've not seen it in China, but in Hong Kong, it's really, really heavy, really heavy. Not only have you taken out the COVID low, you've taken out you got into subsequent multi-decade lows, and it's getting, because you can't pick up a newspaper, you can't be someone working in the city without a broker saying, hey, China's unfashionable, now it's time to buy. Yeah. No one's buying it. I mean, I was thinking we would see quotes in the papers arise. A lot of China and Hong Kong is going no bid. No bid.
Yeah.
You've got Alibaba.
Yeah.
Alibaba's back at the IPO price. Yeah. Now, there's things going on again there. There's I want to suggest there's a malign influence by Softbank.
Mm-hmm.
And Softbank, a traditional telecom company that went bonkers.
Yeah.
And they were allowed to go bonkers because their banking counterparties in Japan they're the wrong side of bonkers.
Yeah.
Yeah. And I think Softbank has no exposure now to Alibaba, but it's all done via derivatives, and it puts really heavy pressure.
Yeah.
And the arm listing as well. I mean, one of my big ifs is Softbank blows up this shit. Softbank is going to disappear. It's no one. You're not allowed to talk about it. We'll be taken off the air. So you can't talk about it. Softbank is crazy bust. But so these are the things, and so I mentioned dollar yen, and finally dollar yen. The real rate is yen renminbi, yen yuan, and so I was saying, tell me the exchange rate, and I'll tell you what the asset prices are. Yeah. Dollar yuan, the Chinese currency, you need about 7.2, what I call red cabbage, to buy one Benjamin. And to my mind, that's everything that's wrong with the world. I think you should require four and a half of the Chinese currency to buy a dollar, given everything, how they've changed and how powerful they are, that their citizens should be richer. And there have been nefarious routes taken to avoid that happening. But when I see dollar yen, when I see the Hang Seng market, when I see, the China, the data, there's no remedy so far. And you can see how they're trying to replace the 30% of GDP that came from the housing bubble with more and more inroads into export markets, which brings them now, you're at the verge of taking down the European automotive market. Yeah. And so you reach a line where people say, you can't cross that line. Does that yuan go 7.20 to the dollar to 7.50 to 8 to 8.50? That's an environment that historically, going back as far as 2015, I've warned that were that to happen, it would be a kind of Mad Max deflationary world. You'd have 10-year back at those lows in the US.
Yeah.
And then other things have been happening. Allied and corollary to that, you always want to be watching corporate transactions. And an old foe of mine from about 10 years ago, Japanese Steel, just announced in December a takeover of US Steel. Mm-hmm. Carnegie would be, what did they say? He'd be restless in his grave. Like, what's going on? What the dickens? So that really that came after a US mining company, shame on me for not being able to remember its name, had bid for US Steel.
Yes.
And being rebuffed. But made a generous offer. And the Japanese came in like 3 months later and like, I think the US group had offered, I'm making these numbers up, but like 25. And the Japanese were like, what about 55? Yeah. It wasn't like, what about 27? What about, it was an insane deal. But why that was of interest is the US market has capacity to produce, I want to say about 120 million metric tons of steel. Japan, about the same. China, I never thought they would achieve this. So they did achieve it. They had achieved it, but I never thought their demand would match it. But they have the capacity to produce like 1.2 billion metric tons of steel.
Yeah.
It's like more than 10 times the size of the US market, 6 times the size of US and Japan together. But up until 2019, they were consuming it domestically because you had a bubble in housing and elsewhere. But, and also, they spent a lot of money on it, infrastructure, and technology, because you can make some shabby steel, if you will, and there's a quality curve.
Exactly.
And what we'd seen back in the day, Warren Buffett used to own Costco, because South Korean steel became the envy of Japanese steel. But it was like, the Chinese will never get there. Well, of course, they're there. Okay. And you now don't have that bubble in the property market, and they're now exporting. And so my thesis going back to 2012 was, my God. So in Japan, Japanese steel companies they're operationally leveraged. You've got a furnace. You've got to run it all the time. Yeah,
bit like that nuclear reactor.
It's expensive.
Yeah.
And then because we live in a world where interest rates are zero, fixed income becomes a volatility product. And so actually they've issued a ton of debt, and they're issuing even more debt to make this deal. They pay nothing. And then because of volatility, and you want to create an extra bit, like the US subprime thing, the Japanese banks, they sell CDS protection. So you can buy $1 million of protection on a default in a Japanese steel company for something like $3,000. Right? I mean, remember, like, and if you go to buy that, and I used to own lots of it, like, you're crazy, it'll never happen. Well, what if this billion plus capacity suddenly says, you know what, we're desperate, we got to keep feeding our furnace. And so desperate people, the Japanese have just jumped into the US. I'm like, interesting. So, I mean, if I was running my fantasy trade for this year, one of them would be that I'd want to pay $3,000 on Japanese steel companies on the risk that the market will suddenly wake up to what's happening in China and the proliferation of these exports, and suddenly seek to reappraise something which is trading at 30 basis points in the 5-year on the run might trade at 3,000. That'd be a cool return.
Now, Hugh, last time you were in March, you were waxing lyrical about Greyscale and you'd sort of, I think, made your first foray into Bitcoin. There's been a lot of noise around Bitcoin with the rollout of the ETFs. Have you changed your view at all?
No, I mean, so I have no. I've just got a pretty dumb view on Bitcoin, which has actually served me very well since I became curious about it from early this time last year. So Greyscale, let's just put some color there. Greyscale is an investment trust, which is to say a closed-end fund. And it was an originator. It was one of the first vehicles which allowed institutions and the broader church of people to come in and gain an exposure to Bitcoin. Those not willing to have it in a digital wallet and pay all the fees for jumping over these different platforms. And that was a big deal. And as the Bitcoin continued to take off and had these periodic kind of S-curve movements, people clamored for that exposure. Because if you could get a bit of Bitcoin in your equity fund, wow, you know, that's the kind of stupid stuff I used to do when I was running European mutual funds. I'd have, but you know, back in the day when NASDAQ was collapsing, I'd have Swiss bonds, and people were like, but that's not a European stock. I'm like, who cares?
Exactly.
It's going up, you know?
Exactly.
But so what happened in the clamor, and with some technical things, a professional, there's a term in America, a registered investor, let's say, you could actually call up Greyscale and ask them to issue more stock, which would be a 6-month period, but it'd be issued at par. But it would be trading at a premium to par, and your best case, your strongest conviction would be over the next 6 months, Bitcoin would be up at least 20%. And so that created a huge hedge fund trade, people coming into this Greyscale, they were issuing this stock, and then you would sell and take your profits. Now, there was another character that I interviewed in my my podcast, Kyle Davies of Three Arrows.
Yes. Yep.
So my buddies were doing this trade. They're doing this trade in like $1 million clips, because you've got to be mindful. 6 months, you got to trade it. There's got to be an in and got to be an out. Kyle came in, and Kyle's managing billions at this point with a Bitcoin crypto strategy. I was like, I love this. I'm people are falling over to give me money. So he came in, and there was one point where it's a bit like when a serpent swallows an elephant. So you see the snake, and then there's this big bulge. And the bulge was that you knew in 6 months' time, Greyscale were going to issue not $1 million, but like $30 billion of new stock. Yeah. And that was cool because everyone loved Bitcoin. It was at a 40% premium. Except over the course of the 6 months, it all blew up. And so suddenly people are like, holy, I'm like, who's going to buy? And also, why did it blew up in Grayscale's case? Because there became more and more other means of gaining Bitcoin exposure. Yes. You could buy futures. Yeah. There was a Canadian mutual fund, etc.
And now an ETF.
And now ETFs. So you went from a 40% plus premium to NAV, and Kyle just having to puke this thing, you went to a 40% discount. Of course, Bitcoin fell from 70,000 to about 17,000, and you could actually buy the Bitcoin 40% below 7. You could buy it at 10,000, let's say. And so that's what I was talking about. I was like, you've had a bear market, you've had a profound 4, 5, 6 standard deviation, mean reversion. Don't know when it will remedy itself, but I've got to be there. And then the company came in and they sought to change the status from the closed end to a mutual fund. And people were like, that'll never happen. People doubted, do they really have the Bitcoin? Yes. Did they lend it away?
Been a lot of that.
And all of that, so all of that's passed.
Yeah.
Bitcoin's gone from 17,000 to 42, 43,000, and the discount's gone from has gone from minus 40. It's been a great trade. Now, my dumb idea about Bitcoin is size. The girls say size matters. I don't know. Is the magnitude of the Bitcoin market? So not crypto, just the Bitcoin, and measuring it with the maximum number of coins that can be issued, 21.5 million, let's say, times today's price. You do that maths today, which I haven't done recently, but I want to guess you're about 0.8 trillion US dollars in size, and it ain't big enough.
No, exactly.
It ain't, and it seems to be a legitimate proof of concept. It works. It has scarcity. There's going to be another halving. Halving, I've always been a bit skeptical of, but I think it halving every 4 years, and it always coincides with another big pop in the market. Effectively, what the halving means is that you are the number. So they haven't issued 21.5 million coins yet. The rapidity to which you can mine has just, you're putting a brake against it. Yeah, less. So there's less new supply. Yeah. So what Bitcoin enjoys with the halving, which is unlike gold, and so it's I want to say it's a positive style characteristic, is if the gold price jumps from 20, where is gold to? Sorry, gold is what, 3,000, 2,000 bucks.
Yeah, 2,000.
If gold goes from 2,000 to 4,000, dream on. But if it goes from 2,000 to 4,000, gold miners, copper guy, everyone's going to be
doing
mining it, because you mine gold as an orphan, plus you'd be dedicated to doing. So supply would go up.
Correct.
Whereas we're in an environment with Bitcoin where with the halving, it's the opposite.
Yes.
So that's kind of cute. And my point is, why did I rubbish the notion of gold at 4,000? It's just gold today is $13-14 trillion. So it's 14 times the size of Bitcoin. And I'm just saying, I can imagine Bitcoin could be at 200,000. Yeah. It would be what $2.5 trillion. Yeah. It's like, it's not big enough to like, big deal. Yeah, it could be that. US equities are $50 trillion. So I still think Bitcoin is too small. The price is too low. I'm not proud of that argument, but that's my argument.
No, that makes a lot of sense. And then, Hugh, anything else that you'd like to comment on today? We've had a very good sort of run through 24.
Yeah.
How can listeners get in touch with you? I mean, obviously the asset capitalists are still running strong?
Well, this is a great conundrum because I'm Flo. We were discussing. You're like, hey, come in, let's talk. And I'm like, I've got nothing to talk about. And
Yeah.
You put a microphone in front of me, I can't shut up.
Well, that's why we love you as a guest.
Yeah. And I've not done any podcasts of late. I do have a Patreon service, and even there, I've been a bit floozy, but I'm a little bit remiss. It's not flowing within me as yet. And then the other problem I have is, I'm front of camera. I need technicians to make it happen, and I don't have them just now. So I'm working on it because I do like it. It brings me joy. I am working on you'll like this because Warren Buffett did celebrate apathy and sloth. Okay, and I'm definitely becoming more slothful. And the revolution in AI, I've embraced.
Yeah,
and
it's very modern of you.
I've got a what can I say? A bot. I've got an AI version of me.
Yeah,
and so I wrote a book. I must publish the book.
Yeah.
Maybe I'll do that. But the book has been swallowed up by the AI. 15 years of my Eclectica macro letter has been swallowed up. 3-4 years of all of my Twitter correspondence is within that thing, and others, and so you can ask it questions, and it's pretty because I ask it questions. I'm like, hey Hugh, hey asset capitalist, how's it going? But I said, what is asset capitalism? And I was blown away with the answer. So I'm still working on that, but that's something that I want to release because that's always on.
Yes.
We'll put that maybe on a Twitter channel or something.
Yeah.
You can call it, it talks like me.
Mm-hmm.
And so you can call it and say, and get into a fight because I'll fight you as well, Say, oh, the Fed's going to raise interest rates. No, it's not going to raise interest rates. You're still talking about Japanese steel, you failed on that trade 10 years ago. Now you're still talking about give up. You're a jerk. You're old. So that's something. But yeah. If anyone's listening, they want to help, they want to be the technician to make it all happen, then contact me. You'll find me in www St. Bart's. Not doing a lot.
Fantastic, Hugh. Always an absolute delight, and you're welcome back here anytime.
Thank you. Very much appreciated.
Great.
Thank you.